We've got Matt Graham here dialed in. So good to have you here, Matt, with an update in the markets, looking at what's happening on Friday. And again, we're starting to approach the highs of a year here. Again, bumping up on the limits. Golly, it's just, what do you say about this?
And I don't say anything good about it. It's not good. Everybody's really upset about it.
Yeah, there's nothing good to say about this. It's not the way we want to end up summer here. Not that we're ending it yet, but it's going to put a wet blanket on it. But let's run through the markets. What's happening?
Yeah, so last week's focus was definitely on CPI, Consumer Price Index, the big inflation report, and that was on Thursday. We came into it with a pretty strong setup. I think bonds, after the NFP rally from the previous week, were gearing up for maybe good news from CPI, and then they got it and didn't really do much with it initially. And that was interesting because there was quite a bit of buildup heading into CPI. And what was more interesting is that we ended up selling off fairly aggressively, very aggressively during the rest of the day. So much so that people struggled to make sense of what was going on Thursday. And there were a couple other potential market movers in play. The 30-year bond auction came out at 1 p.m. Notably, most of the weakness happened either before 1 p.m. or after 1:20 p.m. And you would think that if the 30-year bond auction was the culprit, you would see a good chunk of selling between 1 and 1:20, or at least right after 1 o'clock. Or let's be fair, 1:02 p.m., because those results usually aren't out for about a minute and a half. But I digress. The point being, the 30-year bond auction results were fine. Anything that you see out there saying that the auction was weak, soft, hard to take down, highest yield since however, yeah, of course it was the highest yield in a long time because rates are the highest they've been in a long time. So the auction yields are going to be the highest in a long time. That's not a surprise. The bid to cover was right in line with the 2 of the past 3 months, was right in line with averages for a refunding auction. All of the bidding stats were right in line with recent averages. There was nothing remarkable about the auction. So that was not the culprit. Then the Fed's Mary Daly had some comments about maybe more tightening needed. Those happened earlier in the day. There were no big volume spikes or instances of bond selling following those comments. So the bond market's MO would be to react to that stuff instantly. And really, there was no great headline to line the selling up with. So that forces analysts to start really guessing and talking about big strategic considerations. And one of those big strategic considerations that really made the rounds last week was this shift from the notion of a soft landing to a no landing when it comes to how the Fed might engineer this exit from restrictive monetary policy and how it might balance the needs of inflation fighting versus not crippling the economy. You were here when rates first started rising as fast as they were, and everybody thought, oh, surely this results in a big recession and things are going to get really bad really quick. But we haven't had it. There have been some economic data points that you could point to and say, that's not so great. But by and large, things have been more resilient than most people expected. And now, if we're talking about a no landing scenario where the economy just keeps on chugging along at whatever pace, that's not a great thing for bonds or for inflation. You also had some increased quote unquote chatter. I don't love that word because what does it mean? Who's chattering? Some increased chatter about a rebound in fuel prices and food prices that will spill over into inflation, and that we're just really looking at back-to-back CPI reports that are temporarily reflecting a correction and that it could reaccelerate in some way. I don't know if that's the driver, how true that is, but it's something that people were talking about. Another big topic that I know will be popular on this podcast and definitely in the news is the role of government spending, and that we're doing too much of it and not taking in enough revenue. And I would agree with that. And that's definitely a problem for the bond market. It's something that bonds are definitely considering. And it will be something they continue to consider regardless of who's in office, because this is a vast overgeneralization, but in general, you could say that one party likes to spend a bit more and the other party likes to take in a bit less in revenue. Either way, you're issuing more treasury debt, and more treasury debt is not great. And especially right now, It's compounded by the Fitch ratings downgrade. Not that anyone really cares what Fitch says, but it just came at a time when people were sensitive to this notion of increased supply. All that to say that, oh yeah, and you have the Fed pivoting to manage its restrictive policies in the form of holding the ceiling on rates rather than finding the ceiling on rates. So there's a lot of chatter. There's that word again. A lot of chatter about the fact that hikes are probably done, barring some really strong unforeseen data or some alarming inflation resurgence. Rate hikes can be done, and the Fed can just manage its policy transmission via how long it holds the ceiling rate. That means, and as I think we talked about this last week, that all of the volatility in rates, all of the market's response, not the market, the bond market's response to shifting undercurrents of monetary policy, growth outlook, inflation outlook, are expressed in the longer end of the yield curve. And that means more volatility for 10-year Treasury yields and much less for 2-year Treasury yields. We've seen that play out recently. 10s are at the highest levels of the year, whereas 5s and 3s and 2s were higher a couple months ago or last month. And so that's a yield curve thing. And there's a bunch of curve trading going on. Some people were saying that's adding to last week's volatility. But yeah, any way you slice it, you're waiting for the Fed to give you some indication that it has its first rate cut on the horizon. They might not even give that to us in words. They might give it to us in the form of the dot plot. And so that'll be scrutinized in September. But yeah, it's a dark passage right now, getting from wherever we are right now to wherever we will be when we get that indication that short-term rates can come down. That's the first domino that needs to fall before longer-term rates can come down in a meaningful way.
Unfortunately, yeah, this is just one of those ugly times. And I keep waiting for Les Parker's prediction where rates could move lower. Others do. There's a general consensus. Any thoughts on that towards looking forward into this fall and later? What
I mean,
happen?
rates are absolutely going to go lower than they are right now at some point. It's just a question of timing. And I thought we would have hit that mark already myself several times. And I'm not shy about saying when rates were 4% and rising, I didn't see them hitting 7%. But now that rates are 7% and rising, I'm even more certain that they're not going to go another 3% higher because things will start to break. And I think you do have some indications of that in the vehicle market. Saw a lot more coverage last week about wholesale vehicle prices that have started to tank. You don't see it at the retail level yet because, of course, car dealers are going to try to get their money. But that's just one piece of evidence that the rising rate environment is taking a toll and not just on refi demand. The good news is we do have people on MBS Live saying that they haven't seen a big impact on their origination pipelines. They already were very small, but buyers don't seem to be balking at rates like they used to. And I know we talked about that last week, but that continues to be a topic on MBS Live.
That's right. Yeah, I noticed the chatter on you. Chatter. There we go again with that word. Chatter. It's one of those words. It's like they said, who's they? But chatter is one of those things that you just hear generally. It's a term that we use where people are generally chattering away. And I love the chat feature on your MBS Live system. It is so good to get insights into the mindset of where people are at. And I think maybe it's just that you attract people people are going to invest the money to look at the markets like they do and use a system like mbslive.net to do so, are going to be probably on the upper end of the market, more of the ones that are finding ways to succeed in this market. Maybe that's why the chatter or the communication on there is just a little bit more of it's a little more encouraging. It is encouraging to see that people seem to be getting into the mindset. This is where rates are. We've got an opportunity. Like either sell.
We got to make the most of it.
Yeah, let's make the most of it. Exactly. So anyway, great system, man. I just love it. Again, recommend it to anybody that we're engaged with, talking to. I tell everyone now, you did see MBS Live, did you not? mbslive.net. So anyway, folks, you can sign up for mbslive.net by going to mbslive.net, and it'll go to the sign up area and you'll see a invitation for a code. Put in a code, put in LOL. Thank you very much, Matt, for doing that. and it creates an extended trial period. And you'll go in there and like everyone who is going in there of our clients and our listeners, oh my gosh, this is so affordable. Oh my gosh, look at all the information. Oh my gosh, look at this, look at that. And I keep getting emails after people said, look, one of the benefits I've gotten from being a listener on your podcast is getting introduced to mbslive.net. It's such a powerful tool. Kudos to you, Matt. Appreciate it.
Thanks, sir. You bet.
Appreciate you joining here on Zoom. It's a little bit of a change up on our regular podcast, the way we're going about it. Again, thank you for dialing in and being here. Appreciate you, friend.
You bet.